I'm Charlotte McLeod with investingnews.com, and here today with me is Jeffrey Christian, Managing Partner at CPM Group. Thank you so much for being here. Great to have you.
Thank you for talking to me, Charlotte.
Oh, of course. It's always good to have you. And it's been a little while, I realized, since we last spoke. So we'll start with gold because there's a lot going on there. Our last interview was all the way back in July. And at the time you said you're looking for higher highs in the rest of 2024 into 2025, which certainly we've seen that. So I think we need to ask your next expectations for the gold price, given that that's played out.
We think that the gold price is going to continue to strengthen, and we've actually increased our projections for gold prices. And, the reason is very simple. You have a tighter market, but much more importantly, you have a tremendous amount of political and economic anxiety and uncertainty and nervousness around the world. And that's causing investors to buy dollars, U.S. treasuries, gold, and silver. And until those anxieties are lessened, investors will continue to be buying them.
Yeah, I was going to ask you, okay, so the price is going higher, and what are the main drivers? So it's that investor fear and anxiety that's top of the list right now.
It's really investor demand that's driving it right now. Now, we do expect prices to rise, but we wouldn't be surprised to see some softening in the second and third quarters. There's seasonal reasons, and also the anxiety is extremely high right now. We think that by April through August, there may be some normalization of the nervousness, if you will. And you could see a period of time before things back up. That's wholly dependent on what happens in the political and economic environment.
Which is, of course, very, very uncertain right now.
Yeah.
Yeah.
It's crazy to try to project.
It's very difficult. I don't envy your position trying to figure that out. So, okay, so we've got this is the situation for gold right now. There's a lot going on in the gold market, and a couple of things that I want to get your take on, because I know that our audience has a lot of questions. And one of those is the movement of gold from London over to New York. I think that the prevailing narrative is to do with tariffs. This is front running the tariffs. I wanted to get your thoughts on why this is happening.
Well, the arbitrage and the movement of gold started before the tariffs. So the tariffs came later, sort of as an add-on, but also sort of as an explanation for people. The main thing is that you've seen stronger demand for gold in North America than you have, and silver, than you have in Europe. The U.S. economy and Canadian economy have been stronger than the European economies. Investment demand has been greater in the United States and to a lesser extent in Canada than it has been in Europe, and fabrication demand has been. So you had a stronger market and a greater demand for gold and silver in the U.S., and that was coming over. In addition to that, Poland has bought the Polish central bank has put a couple $1 million of its foreign exchange reserves into gold, and it wants its gold stored in New York at the Fed as far away from Russia as possible. So you saw about 2 million ounces of increased demand for good delivery gold in the New York market to meet that central bank. And not just Poland, but some other Eastern European central banks have been buying gold and storing it at the Fed. So that's increased demand. That expanded the arbitrage. Then you saw speculators and traders seeing that arbitrage and say, there's an arbitrage opportunity. So they started doing it, which expanded the arbitrage. And then others came in, and then Trump started talking about the tariffs. And they said, okay, well, the demand is in New York. It's not in London. Let's move it over there. And let's do that. Now, another thing to add on. Okay, so that's what's happened. One of the things to pay attention to is London's not running out of gold, nor is Europe. There's there's hundreds of millions of ounces of gold available to the London market. And you know that because the London price hasn't risen. I mean, it's risen, but it hasn't risen relative to New York. If London were running low on gold or silver, the London price would rise faster than New York, and the arbitrage would reverse. The fact that hasn't happened tells you it's not a crisis in London.
Okay. So many things at play here, and that was a good overview of what's going on. So I had started talking about the move of gold, and then you brought silver into it as well, which I keep forgetting to mention. And I believe that's happening in copper as well. Anything you would add on the silver and perhaps copper?
It's the same thing. Demand is greater. Industrial demand for copper is greater in North America than it is in Europe right now. It's that simple.
And this situation, is this something that just simply plays itself out over time and then it resolves?
Well, the U.S. economy has been more vibrant and stronger and more productive than the European economy, at least since World War II. So there's been a deterioration in the relative performance of the U.S. economy, and we have to see where it goes over the next 2 to 4 years. It could reverse, but in general, the U.S. economy on the long run has outperformed Europe and may well, depending on what these guys do with our country, our province, the 11th province, depending on what they do with the country, it ought to continue that way.
Okay. So as you were explaining what's going on with gold, you said this happened or started to happen even before the tariffs started to come into play. We should probably also talk a little bit more about the tariffs, which I am a little bit wary of asking about because they are changing so frequently. But anything you would add there about the potential effect, I guess, of tariffs on commodities markets?
There are 4 sets of factors that we pay attention to. Tariffs are inflationary. There's no doubt about it. If anybody argues that, well, the data's not in, they're lying, right? They are purposefully blocking reality from their thinking. Tariffs are inflationary and tariffs are recessionary. So we've increased our inflation projections, not just for the U.S., but on a global basis. And we've increased the depth of and timing of our recession that we have projected for sometime in the next 2 years. The next 2 parts are much more difficult because they're political. Well, one's political and one's dependent on the political. That's what are the effects of tariffs on fiscal policy, and then what are the effects of tariffs and fiscal policy and recession and inflation on monetary policy. Those things are really difficult because, as you said, what they're threatening to do tomorrow it keeps changing. So it's very hard to sort of say this is what it's going to be. If you have a very deep recession and higher inflation, that might persist for 2 years, but at some point, more sober thinking may enter into the U.S. fiscal policy, and you might start seeing stimulation, the way you saw in 2008 to 2011, and furthermore. And then the monetary policy has to decide what it's going to do. If it's got higher inflation, maybe interest rates should rise higher. But if it's got lower economic activity or outright recession, that means maybe lower interest rates. And then if you have fiscal policy that continues to be stringent, I mean, if you take $1 trillion out of the U.S. government spending, that's a 5% reduction in U.S. GDP. That's a really deep recession, So then the monetary policies policymakers have to say, what are we going to do in this environment? And they're going to have to say, what are our freedoms and liberties to do our job, because the current administration wants to take that away.
Yeah, it's you can see that there's so many factors at play, and predicting this, I have no idea how you approach that. I was going to ask you about your recession ideas, which we've covered. I was also going to ask you, about the Fed's path forward in 2025, and it seems very uncertain. Is there anything we can say about what the Fed may do?
Well, like I said, when we look at our economic projections, the inflationary consequences and recessionary consequences are easy. But then once you throw in that fiscal question, that confounds everything, and it also confounds the monetary policies. Our view is that the Fed has been doing a very good job. The Fed paused its rate reductions, which we think was the right thing to do. They're going to be watching a variety of factors. And quite frankly, a lot of the real economic indicators are deteriorating. I mean, one of the leading indicators of economic activity is capacity utilization and output of business equipment. And business equipment has been falling for 2 months. Companies are pulling back on hiring, on buying equipment, on building new factories. There are a few that are very prominent in promoting that, but overall, the U.S. economy, the businesses are saying, we're not hiring, and if anything, we might lay off people, and we're not planning on building new factories, except in certain places where the tariffs and government intervention cause us to do that. We're not looking at a U.S. economy that's vibrant.
Okay, and I'm not sure if this is worth talking about, but I'll ask anyway. So we had that little bit of clash between Trump and Powell. I think this is even before the election, possibly, or just after. And now Powell seems to be kind of flying on the radar because I guess Trump and Elon Musk have all kinds of other things to worry about right now. Do you think that that's like a tension that flares up again at some point?
Yes. I think the tension's still there. It's just not getting the media attention. It's there. And I'm sure there are people within the administration and within the Treasury who have been tasked with making the Fed's life hell.
Yeah, I could believe that. Okay, and speaking about other things that Trump and Elon Musk are looking at right now. So we've gotten a lot of questions. There's been a lot of talk around this Fort Knox gold audit and checking out to see whether the gold is still there and that kind of thing. I'm curious to get your take on that whole situation.
We've done several YouTube videos lately on the Fort Knox gold, and we focused on, there used to be this Congressman, Ron Paul, and he's still around, sort of like a strange gadfly type of guy. And for 20 years he was in the Congress, and he kept saying, we need to audit the Fed's gold. Well, it's not the Fed's gold, it's the Treasury's gold. We need to audit it. We need to audit it. And on his way out the door in 2010, his colleagues in the House allowed him to hold hearings. And in his opening statements, and we put this video link in our YouTube videos, in his opening statements, he said, I have been calling for the audit, a deep audit of the Fed's, of the Treasury's gold for my entire career. And in preparing for these hearings, I found out they audit it every year. And there's been a deep audit. And the U.S. Treasury gave him an audit that they had done from like 2000 to 2008, where they took every bar, weighed it, measured it, inspected it, checked it against the bar lists that they had from the 1971 lockdown. Checked every bar, like 6,000, 7,000 bars over 8 years. And then they took representative samples and sent those to an independent lab for assays. And when Ron Paul, the father of all Fort Knox gold conspiracy theories in the last 25 years, said, oh, I want to have this hearing, the Treasury said, well, here's the audit. And he said, why did you not give this to me? And they said, you never asked. You said a lot of really rude things about us in public, but you never once asked the Treasury, and you never once went to the Fed's website where they publish the KPMG independent audits every year. Every year. So my view is the gold's there. They've done everything that is the industry standard. If you talk to other people in the industry and other central banks, they have done more than other central banks. Industry is not a good representation because industry, the metal's coming in and out. This is deep storage. This is stuff that hasn't been touched. A lot of it since 71. They moved a bunch of stuff from the U.S. Assay Office to West Point in the early 1990s or 80s maybe. I guess it was in the 80s. This is stuff that hasn't been touched. So every bar is measured, every bar is weighed, every bar is put in a drum. The drum is sealed. It's signed. The seals haven't been broken. The drums are put in independent vaults within the depositories. The vaults are sealed and the seals are signed. They haven't been broken. No one has been into any of those vaults since the deep dive, the deep assay, right? So that stuff's there. What you're seeing is the Trump administration trying to feed into suspicions of some secret deep state that has nefarious ill intent for the American people. They're feeding into those suspicions that some people have about the government, and they're using anything that they can, from trans operations. I think there have been 6 children under 20 that have had trans surgery, but that's a big issue. The gold is there. Even Ron Paul knew it, although recently they rolled him out and he said, well, yeah, I know they did this deep assay, but I don't believe it. Yeah. They're doing anything they can to feed suspicion of the government.
Okay, very, very thorough explanation. And you kind of answered what was going to be my follow-up question, which is, why then are Trump and Elon Musk focusing on this? And so, because I've been wondering, do they really care about gold? Is that where this is coming from? But for it's just yeah.
They have no interest in gold whatsoever. It's just a matter of trying to find ways to increase suspicion and lack of trust in the government.
All right. Well, I think it was very good to go through that, and I'll take a look at your videos. I'll try and find a couple of the Fort Knox ones and link them in the video description for everybody. So maybe coming a little bit full circle on gold, and then we can move over and look a little bit at silver. Where do you see gold in this current cycle that we're in?
I think we're in the late stages of a cyclical increase, which started in the second half of 2019. And that cyclical increase, we might see a plateau over the next couple of years, somewhat higher prices, a plateau, and then you could see, depending on what happens in the world, if we go into the kind of economic and political dystopia that we're at greater risk since 1941, if we go into that, gold continues to rise. But if we don't, and if the world backs off from this precipice, then you could see gold and silver prices come off for a few years, the way they did from 2013 through 2016. A cyclical decline within a secular bull market, because our long-term view is that we started a secular bull market in 2000, 2002, when the price was $250, and it went up to, $1,900 in 2011. It came down to $1,000 in 2016, and now it's back up to $3,000. And so even using technical analysis, you see a measured move happening. So we see a secular bull market that's going to drive gold and silver prices higher, but we wouldn't be surprised if we're close to a cyclical peak, and we could see some profit taking and some pulling back.
Yeah, okay. I think that gives me a good idea of what you're thinking there for gold. And I will take us over now to silver, which is always very fun.
Right.
So a lot of I think frustration among investors about silver quite often. And a lot of that is because we hear about these big silver deficits and people wonder, okay, if there's this big imbalance, why doesn't the price reflect that? And I saw you recently did a video. The title is Everything You Know About Silver Deficits is Wrong. And I'll link to this one too. I don't think we have time, of course, to get into every detail, but what would be the main premise that you want to get across?
If you want to know if you want to know whether a commodity market is tight, you want to look at total supply, mine production and scrap, less fabrication demand. You do not want to include investment demand, because investment demand doesn't change the silver from silver. It doesn't go into manufactured products. It stays as silver bullion that can be readily resold, and it's not used, right? And you want to know if that market has a deficit of new supply relative to fabrication demand. We created the World Silver Survey for the Silver Institute. They didn't like it because it wasn't bullish enough. They wanted us to add investment demand. So after the first 5-year contract, we said we're not renewing. They went off and found some people who had never done any silver research. They said, do you want to take over the World Silver Survey? We want you to be more bullish than CPM Group. So they added in investment demand, and voila, they have deficits. If you look at their data, you take their deficits, you exclude their investment demand, which is probably too high, their numbers for investment demand, but you exclude that, they have surpluses. There's no deficit in silver as Commodities Research 101 defines it, right? You take out that investment demand, you have surpluses. People ask me, how many years of deficits before we run out of above ground inventories? You can't compute that because there aren't deficits. Well, we keep every ounce that an investor buys and puts in a sock drawer or a safe or a vault is an addition to above ground refined inventories. And above ground inventories are about 6.5 billion ounces, plenty of silver around. That is there because investors have been buying.
So if we take away this whole large deficit angle, that's a big reason that I hear people be so bullish on silver. So, I guess what is your outlook for silver in that case? What is realistic?
Our outlook for silver is predicated on the fact that we have a very nasty economic and political environment. And investors will be looking for safe havens as they have been since 2019. And silver is one of those. As I said, the four things: the dollar, treasuries, gold, and silver. And, in the rest of the world, investors and individuals buy gold and silver. In the United States and other parts of Europe and Canada, a lot of investors will buy silver because they don't have enough money to buy an ounce of gold, right? So, who buys gold in the United States? Well, people who can throw $3,000 into an ounce of gold or more, right? Who buys silver? People who don't have the 40% of the households in America don't have $3,000. They would take every penny they had and then have to borrow some money in order to buy a single ounce of gold. But they can buy an ounce or they can buy 3 ounces of silver. And that's why silver prices will rise. It's an interesting dichotomy because investors say, oh, I'm bullish on silver because of this industrial deficit. The industrial deficit doesn't exist, and the price of silver is rising because the investors are bullish on silver.
Yes, I was sitting here, I think, trying to get my head around that concept. So yeah, that helps to spell it out.
Cognitive dissonance.
Thank you for that. Okay, so that covers a little bit of what's going on in silver. And just before I let you go, usually we take at least a brief look at platinum and palladium, which are looking pretty range bound at the moment. Is that likely to change?
I don't see it changing until there's a more significant round of reductions in South African production. And hanging over that is the future of Russian platinum group metals production and exports, depending on how Russia and the war with Ukraine goes. So, but right now, platinum, palladium and rhodium are suffering because you're losing market share to electric vehicles. About 14% of the market of new production of electric vehicles, light-duty vehicles, was electric vehicles last year. Half of that was in China, and the bulk of the rest was in Europe. So the U.S., Trump trying to cut back on electric vehicles, people selling their Teslas, that's a relatively minor thing. You have lost 14% of the light-duty vehicle market to PGM catalysts over the last decade or so. And that's probably going to continue. That's a big negative that's pushed platinum and palladium prices down, and it's probably going to continue to weigh on that. On the positive side is with the lower prices for both platinum and palladium and rhodium, the South African producers have a lot of properties that aren't profitable. At some point, our expectation is that some of those properties will close. You'll see another 5 to 10% reduction in South African production. That could push platinum and palladium prices higher. But barring a significant reduction in South African production or something weird with Russian exports, we're kind of bearish on platinum and palladium as investment products.
Yeah, okay. I think that's a good summary of the situation there. And I need to let you go, but before I do, any final thoughts you would leave investors with? We've covered a lot of ground.
People have to diversify their information imports, and they have to do the work to study these things. There's an enormous amount of information out there. It's boring as hell. I mean, my wife is mortified by the stuff I read at night, but it is very important to understand. And if you don't understand it, find somebody who can explain it to you, who's not trying to sell you precious metals.
I think that's a good place to wrap it up. And thank you for doing all of that reading for the rest of us.
I hope it's good.
Yeah. Well, thank you very much. I'll let you go. Once again, I'm Charlotte McLeod with investingnews.com, and this is Jeffrey Christian with CPM Group.